Welcome to our deep dive today. We're going to be looking at some stuff from Al Brooks' book, Trading Price Action Trends. You guys have sent in some excerpts, and, well, we're ready to uncover what's in this book.
Yeah, it's all about understanding what those little movements on a price chart are telling you. Like reading the whispers of the market before it makes a big move.
Okay, so you're saying it's about anticipating those trends before they fully form. But I'm wondering, for someone who's not a pro trader, why should they care about these tiny little changes in price? I mean, isn't it all about those big, obvious trends?
That's where Brooks kind of turns things upside down. He basically says those little ticks, those little movements, they're actually the building blocks of major market shifts. See, most of the time the market's like, well, it's a 50-50 chance it could go up, it could go down. But then there are these moments, these like crucial moments where the odds tilt. And Brooks thinks those little price actions can tell us when those moments are happening.
So we're not just like passively watching these trends, we're trying to predict them before they even really start.
Yeah, exactly. And Brooks gives you a whole framework for doing that.
Mhm.
He looks at the different types of price bars, things like trend bars, doji bars, reversal bars. Each one of those has a certain look, a certain visual cue that tells you something about how the market is feeling.
Okay, that sounds kind of like learning a whole new language. And to be honest, a little intimidating. Is this something anyone can learn? Or is it only for the super experienced traders out there?
Brooks actually wrote this book for both beginners and pros. He starts with the basics, so even if you're just starting out, you can follow along. And we're here to help you to, break down the main points and make it all make sense.
Oh, good. That makes me feel better. So let's start with that core idea then, this idea that those small price shifts are what really matter. Can you walk me through how he uses that to actually like predict where the market is headed?
What's interesting is how much Brooks focuses on the idea that the market is kind of constantly dealing with uncertainty. He describes it like this back and forth, almost a tug of war between the buyers and the sellers. Yeah, and he thinks that by looking closely at those little bars on the chart, the size, the shape, and the order they appear in, you can start to see which side, buyers or sellers, is starting to win that tug of war.
Okay, that's starting to click a little bit. But you mentioned all those different types of price bars, trend bars, doji bars, reversal bars. It seems like a lot to remember. Can you break down what each of those means and how they play into this whole predicting the market thing?
Of course, picture price chart like a heartbeat on a monitor.
Oh,
Each bar is a pulse, a little bit of information about the market's rhythm. So a trend bar, where the closing price is higher or lower than the opening price, that tells you who won that particular battle.
so like a strong, steady heartbeat means the market is moving decisively in one direction.
Exactly. Either the buyers were strong and pushed the price up, or the sellers were in control. The longer that bar is, the stronger that move was. Then we've got those doji bars, which are more like, I don't know, maybe a skipped heartbeat. Yeah, they're little tiny bars where the open and close prices are basically the same. It's like a moment of equilibrium, a pause before the next move.
So neither the buyers or sellers could really take control.
Exactly. Now, those reversal bars, they're like those sudden spikes on the heartbeat monitor.
Oh.
They hint at a potential change in direction. Imagine you're looking at a downtrend. Prices have been falling. Suddenly you get this bar that closes much higher than it opened, often with a little tail at the bottom. It's like the market hit a wall.
So like it slammed on the brakes and might be about to reverse.
That's the idea.
Yeah.
It suggests that the buyers are stepping in and the downward momentum might be ending. Brooks actually has this great example in his book. It uses a buy-do chart. There's a strong bullish reversal bar, but instead of going up, the market breaks down below it, creating a shorting opportunity.
Wow. So those bars can be misleading sometimes.
Well, not really misleading, but definitely counterintuitive sometimes. Remember, the market wants to keep us guessing.
That's for sure.
Brooks teaches you to recognize those clues and sometimes do the opposite of what seems obvious.
Wow. So we've got these individual bars as our clues, but how do we put those together to see the big picture? You mentioned something called setups earlier. What are those?
Setups are basically a combination of those price action signals, like a pattern that suggests there's a good chance, a high probability of a trade working out, like the two-bar reversal. Imagine two bars right next to each other. The first one is strong and moving down, but then the very next bar is strong and moving up. It's a sudden shift that might be signaling a change in the trend's momentum.
Got it. So it's not just about individual bars, but how they all fit together to tell a story, right?
Right. And Brooks has this framework for understanding those stories and then using them to make decisions about your trading.
Okay, this is all starting to click now. But we've been talking about individual bars and setups. What about the overall trend? How does Brooks think about analyzing those?
That's where this idea of the spike and channel comes in. He goes beyond just saying, oh, it's an uptrend or it's a downtrend. He says trends actually have these two phases. First, there's this sudden, sharp move, the spike, and then it settles into this more measured channel phase.
Hey, I'm curious. Tell me more about those phases.
Imagine like a rocket launch. The initial blast off, that's the spike. It's fast, almost vertical, strong momentum. That's when the market is really making a move.
Okay.
And then after all that energy, the rocket settles into this more controlled path. That's the channel phase. The market's still trending, but it slows down, it takes a breather.
So it's like sprinting off the starting line and then settling into a more like sustainable pace.
Yeah, exactly. And Brooks says understanding those phases is key. You wouldn't trade the same way during that explosive spike as you would during the channel.
Makes sense. So it's not just about jumping on any upward or downward move. You have to know where we are in that trend cycle and adjust accordingly.
Right? Brooks wants us to be able to read those little signals and adjust our approach based on how the market is acting in that moment.
This is all really insightful, but I notice in the book, Brooks also talks a lot about the psychology of trading. Why is that? I mean, isn't trading all about the charts and the numbers?
That's what makes Brooks so different. He knows trading is just as much a mental game as it is a technical one. And he talks about all the psychological traps that even experienced traders can fall into.
Really? Like what?
One of the biggest ones is getting caught up in the wrong time frame. Brooks says if you're zoomed in too close on those minute-by-minute charts, you lose sight of the bigger picture.
Oh, I can see that.
Yeah, you start seeing signals that aren't really there, overreacting to little price changes.
Oh, yeah, I've totally done that. It's like going down a rabbit hole.
Exactly. And that's where discipline is key, Brooks says. Have a plan and stick to it. He reminds us that we don't have to win every trade. Sometimes the best trade is actually no trade at all.
That's easier said than done, though, right? Especially when you see the market moving and you get that FOMO feeling. What are some ways to stay disciplined like that?
Brooks says set realistic expectations. Trading is like a marathon, not a sprint. It's about making good decisions, not chasing every little move.
That's a good point. It's easy to fall into that gambler's mindset, thinking every trade needs to be a winner.
Exactly. And that's dangerous. Brooks wants us to take a more measured approach, manage our risk, protect our money.
So it's not just about making money, it's about not losing it unnecessarily.
Right. Minimizing those losses is just as important as getting big wins.
This is all so insightful. I'm starting to see how that psychology plays a huge role.
Absolutely. Brooks believes understanding yourself is just as important as understanding those charts.
This has been an amazing dive so far. I already see those price charts so differently.
It really is amazing how much information those little movements can give us. And we've just scratched the surface. There's so much more to uncover.
Wow, okay. I can't wait to dig deeper.
So now that we've got a handle on what individual bars tell us, let's talk about these two-legged moves Brooks talks about. They show how the market often hints at what it's going to do next.
Two-legged moves. Okay, tell me more.
It's kind of like the market testing things out. Let's say we're in an uptrend, right? And the market makes a strong push higher. That's the first leg. Then it pulls back a little bit, takes a breather, but then it tries to push higher again, the second leg. Now, here's the thing. If that second leg doesn't break above that previous high, that often means a reversal could be coming.
So it's like it tries to break through that level twice, but it can't.
Exactly. And Brooks points out that this two-legged failure often comes right before a change in direction. It's like the market saying, okay, I tried that, didn't work, time to go the other way.
So this pattern can help us spot reversals before they really happen.
Yep. Brooks uses this image in the book. Think of a ball bouncing down a set of stairs. Each bounce is a leg, and if it can't bounce higher than the last one, it's probably just going to keep going down.
Oh, I like that visual. Very clear. Now, earlier you were talking about trends happening in that spike in channel pattern, and you mentioned it's like the most common type of trend. Can you say more about why that is?
Well, think about it. Almost every time the market makes a big move, it starts with that sudden burst of energy, that initial spike. It's like the spark that gets the whole trend going. Then, as that move kind of matures, it settles into that channel phase, where you see those swings and pullbacks.
So even those trends that seem smooth from far away are actually made of all these mini spikes and channels.
Exactly. Brooks even goes deeper, breaking down these spike and channel trends into different variations.
Oh, like what are some of those?
Well, there's the trend resumption. Imagine the market's made a strong move, but then it pauses, takes a break, forms a narrow trading range. Kind of looks like a flag waving on a pole.
Oh, so the market takes a break before continuing on its way.
Right. And that flag pattern usually means it's just consolidating for a bit before the trend picks up again. Traders watch for buy signals if the trend was up and sell signals if it was down.
Got it. So those pauses don't necessarily mean the trend is over. What else? What other variations are there?
Well, then there's the failed breakout, which can be tricky. Imagine the market breaks out of that tight range, everybody gets excited, but then it quickly reverses and goes right back into the range. It's a fake out.
Oh, I've definitely seen those. It seems like a breakout, but then it just fizzles out.
Yeah, and those can really trap traders who jump in too early. Book says wait for confirmation before you jump on board a breakout. You got to read those price action signals carefully.
This is great stuff. It seems like there's a whole psychology to reading these charts.
There is. And Brooks spends a lot of time in the book talking about that mental side of trading.
Let's talk about that. What are some of the mental traps, those psychological traps that traders, especially new price action traders, should watch out for?
The biggest one, I think, is getting stuck in the wrong time frame. Brooks says that if you're just staring at those minute-by-minute charts, you miss the big picture.
Yeah, you start seeing things that aren't really there.
Right? You start seeing trends and patterns that don't actually exist. You're overthinking it, basically.
Totally. And Brooks says discipline is key here.
Yeah, he really stresses that. Have a plan and stick with it even when you're feeling emotional. He says not every trade has to be a winner. Sometimes the best thing to do is just, sit on your hands.
Oh, I know that's good advice, but it's so hard, especially when you see everyone else making money. What helps you stay disciplined?
Honestly. Brooks' advice about setting realistic expectations. This isn't about getting rich quick. It's a long game. It's a marathon, not a sprint. It's about consistency, making smart decisions over time, not chasing every little move.
That's a good reminder. It's so easy to get caught up in that gambler's mindset, thinking every trade has to be a home run.
Right. And that's when you get into trouble. Brooks is all about taking a more, maybe a calmer approach. Focus on managing your risk, protecting the money you have.
So it's not just about making money, it's about not losing it on stupid trades.
Exactly. Minimizing your losses is as important as those big wins.
I'm starting to see how all this ties together.
Brooks really emphasizes that. Knowing yourself is key to trading successfully.
So we've talked about psychological traps. Can we go back to those reversal days you mentioned? Are there certain things we should look for in the chart?
Oh, absolutely. Brooks has some great examples in his book. One classic pattern is a strong reversal bar that forms right at a key support or resistance level.
So if the market's been in a downtrend and then suddenly you see a strong bullish bar at a previous low point?
Exactly. That often means the sellers are losing steam and the buyers are starting to take control. Like the market hit a wall and bounced back.
Oh, that's a good way to picture it. It's like when a pendulum swings back in the other direction.
That's a great way to think about it. Another thing Brooks points out is a series of higher lows or lower highs forming after a trend has been going on for a while. That can mean the market is running out of energy, getting ready to change direction.
So it's more of a gradual shift, like the market's slowly making up its mind to change direction.
Right. And those patterns are so helpful because they can tell us about potential reversals before everyone else sees them.
Okay, so we've got reversal days. What about those times when the trend is just strong and keeps going?
Those are what Brooks calls trend resumption days. They're continuation patterns, which means the trend is likely to keep going in the same direction.
How can we spot those on the chart?
One common signal is a breakout from a tight trading range. But the breakout has to be in the direction of the previous trend. Then the market's been taking a breather, consolidating in a tight range, and then boom, it suddenly bursts out with strong momentum.
So it pauses to gather its energy before moving on.
Yeah. Right. Another clue is a series of higher lows or lower highs, but within that trading range. It shows the momentum is still going in the same direction.
So even in those quiet periods, the price action is giving us hints about what might happen next.
Exactly. And that's the power of price action trading. It's all about noticing those subtle clues, those hints, and then using them to figure out what the market might do next.
This is all incredibly helpful, but before we move on, can we talk about something you mentioned earlier, risk management? Why does Brooks put so much emphasis on that?
It's absolutely crucial. Even if you become really good at reading the charts, you're still going to have losing trades. It just happens.
So it's not about always being right, but about knowing how to handle those losses.
You got it. He says you have to have a plan for when you're wrong, because otherwise those losses can really pile up.
Okay, so any practical tips for managing risk? I'm sure our listeners would love to hear some specific things they can do.
One of the easiest things is to use stop-loss orders. Think of it like a safety net.
Can you remind us what a stop-loss order is and why it's so important?
A stop-loss order basically tells your broker to automatically sell your position if the price drops below a certain point. This keeps you from losing too much money if a trade goes against you.
So it's like setting a boundary, like, okay, I'm willing to lose this much, but no more.
Exactly. And Brooks says it takes the emotion out of it. You're not sitting there second-guessing yourself or hoping for a miracle. You have a plan, and you stick to it.
Makes sense. Any other tips for risk management?
Another big one is diversification. Don't put all your eggs in one basket, as they say.
Right.
Spread your risk, trade different assets, use different strategies. That way, if one trade goes bad, it doesn't wipe you out.
So don't bet everything on one trade. It's like having a balanced portfolio helps manage your risk.
That's it. Diversification is like a safety net for your whole trading account.
This is really good advice. I think a lot of people, myself included, need to focus more on that risk management side of things.
It's so important, but a lot of people don't think about it enough. It's the foundation of trading well over the long term.
Okay, so we talked about risk. Now for something a little more exciting. What about those second entries Brooks talks about? What are those all about?
Second entries are kind of cool. It's like getting a second chance to jump into a trade that looks good.
Okay.
Say you see this great setup forming, but for some reason you missed the initial entry. Maybe you were busy, maybe you weren't sure. Well, second entries give you another chance to get in on that action.
So it's kind of like buy the dip, but using price action.
Yeah, you could think of it that way. Those second entries usually happen during those pullbacks, those pauses in the trend, after an initial breakout. So
Yeah.
like the market shoots higher, pulls back a little to retest that breakout level.
Oh, so it's like giving us another shot to get in at a better price.
Exactly. Brooks has examples in the book about how to spot those opportunities and take advantage of them. Patience is key. Wait for those high probability setups.
I'm starting to see how this all fits together. It's not just about catching the initial move, it's about knowing how to ride that wave as it develops.
Yeah, it's like surfing. And Brooks gives us the tools to recognize those waves and surf them well.
I like that analogy.
Yeah.
Okay, before we get too carried away, I want to ask about something else Brooks mentions. These two different approaches to trading, always in and always out. What's the difference?
These are two different mindsets you can have about trading. The always-in trader thinks there's always something happening, always money to be made, no matter which way the market's moving.
So they're like the adrenaline junkies, always got to be in on the action.
Right. They're okay with risk and always looking for setups, whether they're buying or selling. Now, the always-out trader, that's a different story.
So what are they like?
They're pickier, more patient. They're looking for quality over quantity. They'd rather sit on the sidelines, waiting for the perfect moment, the perfect setup, before they jump in.
So they're more like, I don't know, snipers, waiting for that perfect shot.
That's a good way to put it. They're disciplined and don't like to take big risks. They know that sometimes missing a trade is better than losing money.
Interesting. So which approach is better?
You know, neither one is necessarily better. Brooks says each approach has pluses and minuses. It really depends on your personality, how you like to trade, how much risk you're okay with.
So it's about figuring out what works best for you.
That's it. Find your own style.
Does Brooks prefer one over the other?
Actually, he says the best traders often do a bit of both.
Really?
Yeah, they stay aware of what the market's doing, always watching for opportunities, but they're also very careful and disciplined, not just jumping into every trade.
So it's about balance, being active but also patient.
Exactly. Being ready to seize an opportunity, but also smart about managing your risk.
This makes me think about something else we talked about, self-awareness. You got to know yourself to trade well, know your strengths, your weaknesses.
Absolutely. Brooks's book is really about that, not just understanding the market, but yourself too.
That's so important. Okay, before we wrap up this part of the deep dive, I want to ask about this thing Brooks calls the trader's equation. That sounds kind of mysterious. Tell me about it.
The trader's equation is this simple way to look at how profitable a trade might be, but you do it before you even enter the trade. It helps you decide if the risk is worth it.
Okay, walk me through it. How does it work?
Well, it looks at three main things: the chance of the trade working out, how much money you could make if it does work, and how much money you could lose if it doesn't.
So it's like a cost-benefit analysis for trading.
Exactly. You're weighing the potential upside against the downside, trying to figure out how likely each outcome is.
I can see how that's helpful, but how do you even know the chance of winning or losing? That seems like super subjective.
It is subjective, but it's based on your understanding of the market and how much you trust your setup. Like, if the setup fits your strategy perfectly and the overall market looks good, you might think the chance of winning is higher.
So you use both your analysis and your gut feeling about the bigger picture.
Yep. And the trader's equation helps you put a number on that so you can make a clearer decision.
This is such an interesting concept, and it brings together all this stuff we've been talking about, understanding those price movements, managing risk, knowing your own biases.
It does. It's a way to think about trading in a holistic way.
This has been another great session. I'm feeling a lot more confident about reading these charts and making good decisions now.
I'm glad. It's amazing how much info those charts have, isn't it? But we're just getting started. There's so much more to learn.
I'm ready for more. Let's keep going. All right, let's jump back in. Last time we were talking about that trader's equation, and I'm really starting to see how this whole system that Brooks talks about, it's not just about seeing patterns on the charts, it's so much more than that, right?
It really is. It's
Uh-huh.
about understanding how the market thinks and maybe even more importantly, how you think as a trader.
Yeah, and that brings us to something else that caught my eye. This idea of reading the market's intentions. It sounds kind of, I don't know, mystical, but I think you said it's actually very practical.
It is. It's not like we're literally reading minds or anything,
Okay, good.
but it's about understanding the forces behind those price movements, supply and demand. Every time the price changes, it's because buyers and sellers are battling it out. And what Bricks teaches us is to look at those bars, the size, the shape, how they're arranged, to get a sense of who's winning that battle.
So it's like, I don't know, like analyzing footprints in the sand,
Mm-hmm.
trying to figure out who was there and where they were going.
I like that. It's about looking for clues, for patterns that reveal what's really going on.
Okay.
Like, imagine a strong trend bar, but with a very short tail.
Okay.
That shows conviction, right?
Yeah.
It means the buyers or sellers were really determined to push the price in that direction.
Yeah.
But a bar with a long tail, that's different. That suggests hesitation, like someone's not sure if they want to jump in or not.
Oh, I see. So it's not just which way the bar is going, but the shape, the size, all those little details tell a story.
Exactly. That's what makes price action trading so powerful.
Yeah.
It's about seeing those nuances that other people miss.
I'm really starting to see that now. It's like learning a whole secret language.
It is. And Brooks gives us the tools to decode that language. He even talks about something called bar counting, where you look at the number of bars in a swing to figure out potential turning points. The idea is the market often moves in these cycles, with swings lasting for a certain number of bars.
So we're using history to try to predict the future, in a way.
Sort of. By looking at past patterns, we get a sense of when a move might be ending. We can't know for sure, but it gives us a better framework for making decisions.
This all makes sense, but honestly, it's also a little overwhelming. There's so much to remember, different bars, setups, psychological stuff, the overall market. How do you keep it all straight in your head?
Practice and experience help a lot. But Brooks has this one rule that can make things easier.
Yeah.
Trade with the trend.
That seems simple enough, but why is it so important?
Because when you trade with the trend, you're working with the market, not against it. Like, imagine sailing a boat. If you try to sail into the wind, it's going to be tough. But if you use the wind to your advantage, it's much smoother.
Okay, that makes sense. But how do you figure out what the trend is using price action?
Remember those higher highs and higher lows we talked about?
Yeah.
Well, if the market keeps making higher highs and higher lows, that's an uptrend. And if it's lower lows and lower highs, it's a downtrend. Once you know the trend, you look for setups that go in the same direction.
So you're riding the wave, basically.
Exactly. Brooks gives us all these tools to do just that.
This has been such an amazing deep dive. I feel like I've learned so much about this whole price action thing in such a short time.
It's amazing, isn't it? All the information packed into those price charts. And we're really just scratching the surface.
That's what's so cool about it. There's always more to discover. So as we wrap up, what's the one big takeaway you hope our listeners walk away with? What's the most important thing they can apply to their own trading?
I think Brooks would say, be curious, be open to learning, and be willing to adapt. Price action trading isn't about following strict rules or memorizing patterns. It's about truly understanding how the market speaks, and then using that to make smart decisions.
Yeah, it's like becoming a student of the market, Always paying attention, analyzing, and refining your approach.
Right. And that process of learning, that's what makes trading so exciting.
Well said. Thank you so much for guiding us through this deep dive into price action trading. Our listeners have a lot to think about now.
It was my pleasure. Remember, the market's always talking to us. We just got to listen.
And thanks to Al Brook's book and your expertise, we're all better listeners now. To everyone listening, keep exploring the world of price action, and until next time, happy trading.